Just this guy. And I'd like to welcome everyone to Columbus, Indiana as well, where, believe it or not, it is back to school time. In fact, my children just went back to school last week, and my youngest just went to kindergarten. So it's a big day in my house, or a big week in my house this week. So where are my slides? Here we are. Okay, it was fun while it lasted, and now it's getting a little scary. So, got a little bit less scary this morning, actually. If you looked at the headlines, the U.S. Trade Representative's office actually delayed some of the tariffs this morning, so we got a little bit of a positive news on it. I think it was cell phones and laptops get delayed until December, so markets are up today. But this is a little bit about who I am and how I came to be here. I'll skip through that a little bit quickly. This is a little bit more about who ACT is and about who we are. And here's what I'm going to be talking about. So first, I'll start off with talking about freight as a driver of the Class 8 cycle. It is, in our view, one of the most important drivers, especially of the tractor market. Then I'll go into the current supply-demand environment in the trucking industry. We'll talk mostly about truckload, a little bit about LTL and intermodal as well. And then we'll talk about the forecast for 2020 from a freight perspective, and also obviously what that means for Class 8. So starting off, just to kind of ground us here in why we're talking about freight, it is the major underpinning of the Class 8 cycle. Class 8 tractor demand is really based on how much freight that needs to move. So but how does that happen? The second bullet here talks about the supply and the capacity is really what drives freight rates. And one of the things I like to say as now that I'm an ACT employee for the last couple of years now, it almost feels like there's this force out there that people talk about that they don't totally understand. I think Adam Smith called it the invisible hand. Well, I think with our supply and capacity modeling, we can essentially illuminate that, which is what I'm really excited to do and talk about how supply is driving rates. Now, rates then will drive how much profit goes into these trucking companies, and that is the money that they use to buy trucks. So that's the transmission mechanism, if you will. So jumping right into the demand environment, freight is in a recession. It's been going on for about 7 or 8 months. It is very important to differentiate it from a broader economic recession. The economy is still chugging along fine, as you heard this morning, led by the consumer. But the for-hire freight markets, I should be more specific, the for-hire freight market is really what is in recession right now. The private fleets, which we'll hear a little bit more from Tom later today, have been growing pretty aggressively over the past 18 months or so. I think they were one of the first ones into the OEM order backlogs when capacity really crunched back in 2017. And so I think that's where a lot of the growth came from. It certainly also came from small and medium-sized fleets on the for-hire side, but a lot of the data they'll run through on the freight side is the for-hire market. So keep in mind that for-hire market may be down significantly, but private fleet freight hauling is growing fairly significantly. So the overall freight recession is very mild. We're not saying things are falling apart here. The key factors that have driven this slowdown, we've talked about a lot of this already, but certainly we do think that the trade war is having a negative impact, mainly on manufacturing. And of course, there's been these inventory swings that I'll talk a little bit more about related to the trade war too. But the positive news here is that freight cycles are much shorter than economic cycles. They tend to go up for about 2 years and down for about 1 year. If you look at the history, it's actually a little bit more than 2 years on the upside, and maybe we're saying 1 to 2 years on the downside. And so this one's been going on for coming up on a year, and so we should be through some of the cyclical effects that have been driving this down. And so I do think that assuming the macroeconomic forecasts are correct, then at some point in 2020 we'll get back to a decent level of growth in freight. Now, there is a bit more of a 2020 freight recession risk continuing because of the trade war issues, but I'll talk to that a little bit more in a minute. So just bringing us through current freight volumes. This is the cash shipment index. The The black line here is our seasonally adjusted version of it, and that is now down 11% from the high in May of 2018. So it's down about 7% on a year-over-year basis, but it's shown a pretty significant correction. And again, I want to remind everybody this is a for-hire market index. It doesn't take into account what's happening at the private fleets. A couple of other important, or actually not a couple of other, one other important freight data series here is the LTLs. This shows CAS again on a year-over-year basis, but interesting on this chart is LTL's been negative since late 2018. Volumes or tonnage has been declining, kind of mid-single digits, but July actually showed an interesting second derivative improvement where a lot of these declines started getting a lot less negative in July. Part of that's just easier comparisons. We didn't hear too many signs that that the industrial sector is picking up, but LTL tonnage is very closely tied to the industrial sector, and so that'll be a key one to watch. And we do have a interesting private LTL carrier who's going to talk to us tomorrow about what they're seeing in the world. So I think that'll be very interesting because, again, it ties very close to the industrial world. So going over to the railroads, it's a pretty ugly picture this year. There's been a lot of talk about how weather has impacted things. Certainly has. There was a rough winter. There was Midwest flooding. There's a range of issues. You've also got railroads who are implementing what's called precision scheduled railroading out there, who are actually removing some intermodal lanes. So the intermodal numbers may be a little bit, again, sort of underperforming what's the reality of the market, but still down 4 or 5% the last couple of quarters is fairly negative. We've now got I think it's something like 28 weeks of consecutive down weeks in rail volumes. It is pretty broad-based outside of petroleum, which you can still see growing nicely. The crude by rail story is still going. That probably actually is going to hit a headwind next year when some new pipelines open up. But that's the one area of growth on the railroads right now. Pretty much everything else is declining. And as Mark mentioned this morning, coal volumes are starting to come down fairly significantly as well. Just another interesting point, less from a freight perspective, more from an environmental perspective. It's good news that natural gas is at $2 per million BTUs and is forcing a lot more coal plant shutdowns. This is one of my favorite industrial leading indicators that we get from the transportation data. The blue line here is LTL weight per shipment. And so we have the tonnage data from the LTLs and we have the shipments data. And we find that when weight per shipment declines, it tends, the ISM index tends to decline about 3 months later. And while LTL tonnage is more coincident with what's happening in the industrial sector, this weight per shipment is a real good leading indicator because it basically tells you how much is being ordered in each shipment from a macro perspective. And that declined, again, late 2018. That turned negative. The minus 2% on this chart is actually consistent with the 50 on the ISM, and it's running around minus 2 or 3. So that would argue that this industrial slowdown is probably going to keep going for a little while here. So here is our point on trade wars are not good or easy to win. My point on what's happening or what are the impacts of the trade war on the United States. I think one of the reasons that we're seeing a manufacturing slowdown is what's happening on the export side. And in 6 out of the last 8 months, exports have been down year over year. And so I think with the stronger dollar and the higher tariffs are the main culprits of this industrial slowdown that we're seeing. And I do think it's difficult to estimate what the impact on the economy is going to be over the next year from this trade war because we really don't have a lot of good historical comparisons. I mean, literally the last time tariffs went up this much was the Smoot-Hawley Act that preceded the Great Depression. So I am still very worried about the overall trade war outlook and the risk that poses to the economy. And this is certainly one way that it will manifest itself. But in the short term, I think there's a possible pre-ship. And again, going back to this morning's news of delaying the tariffs on iPhones and laptops from September 1st to December, well, that actually increases my conviction that people are going to pre-ship those things ahead of the tariffs. I mean, if you're a shipper, it's your job to minimize costs and risks, and so you're going to want to build safety stocks of those kind of items. At the same time, as we talked about earlier, there is going to be some sort of resourcing of supply chains moving out of China, and I think that we're hearing a lot of that going into other parts of Southeast Asia, back to Mexico. But Dave, to your question from earlier, I don't know how much of it's coming back to the U.S. It certainly is, but I'm not sure how much is going to come here. I would say it's going to go from China to other low-cost places. But I do think this is a pretty good roadmap for the next few months. And if you notice, the pre-ship last year happened really in the fourth quarter, where you saw spikes in imports, and that kept going on the rails until basically the third week of January was when rail volumes went from positive to negative. So there was this surge of freight that came in, and it was very clear early this year that we had too much inventory, and then I think that's definitely a factor that has driven this freight recession.